Most traders don't realize this, but gold is the market that exposes the truth about your trading faster than anything else. And that is exactly why it is both feared and misunderstood, because gold doesn't reward hope, it rewards structure, patience, and discipline. And if you learn to trade gold properly, it will teach you skills that transfer to every other market you ever touch. Before we talk about strategies, entries, or risk management, you need to understand why gold is different, because once you understand what gold actually represents, you stop fighting it and start working with it. Gold is not just another instrument, it is a global store of value and a fear barometer for the entire financial system. And when uncertainty rises, inflation expectations shift, or confidence in fiat currencies weakens, money flows into gold aggressively, which is why gold moves harder, faster, and cleaner than most markets when it decides to move. Unlike many forex pairs that are constantly manipulated by central bank policies and artificial stability, gold reflects raw emotion, fear, and risk sentiment. And that makes it one of the most honest markets in the world if you know how to read it. Another reason gold is one of the best markets to trade is liquidity, because gold has massive institutional participation, meaning tight spreads during active sessions, clean reactions at key levels, and consistent behavior around liquidity pools. And this liquidity allows professional traders to enter and exit with precision without needing exotic strategies or complex indicators. Gold also trades nearly 24 hours a day, giving you flexibility, but it concentrates its real movement into specific windows, which means you don't need to stare at charts all day to trade it well. Gold is also one of the few markets that respects technical levels exceptionally well once liquidity has been taken, which makes it ideal for price action traders, because highs, lows, previous day ranges, and major zones act like magnets for price. And when those areas are violated, gold often reacts with powerful reversals or continuations that offer high-quality opportunities with controlled risk. This behavior makes gold superior to many markets where levels are constantly chopped through without intention. The biggest mistake traders make with gold is treating it like a slow, technical market, because gold is explosive by nature, and if you approach it with the mindset of prediction instead of reaction, it will punish you relentlessly. So the foundation of gold trading is not guessing direction, but identifying where liquidity sits and waiting for the market to reveal its hand. Gold does not move randomly, it moves from liquidity pool to liquidity pool. And your job is to align yourself with that movement instead of standing in its way. Every professional gold trading day starts with higher time frame context, specifically the daily and 4-hour charts, because without context, entries are meaningless. And on these time frames, your only job is to determine whether the market is overall bullish, bearish, or ranging, and to mark critical levels such as the previous day high, previous day low, weekly highs and lows, and strong impulsive origin zones where institutions previously entered aggressively. These levels matter because gold remembers them, and when price returns, reactions are rarely accidental. Timing is everything in gold, which is why professional traders focus on sessions instead of trading randomly, because gold shows its true intent during the London and New York sessions, especially during London Open, New York Open, and high-impact economic releases, while the Asian session is typically where price consolidates, builds liquidity, and traps impatient traders. By aligning your trading with active sessions, you dramatically increase your probability without changing a single technical rule. The core strategy that works repeatedly in gold is based on liquidity manipulation and confirmation, because gold loves to take stops above obvious highs or below obvious lows before making its real move. And these stop hunts are not accidents. They are how large players enter positions without excessive slippage. When price breaks a high or low aggressively and then immediately rejects, that is often the signal that liquidity has been taken and the true direction is about to unfold. A high probability gold setup looks like this. Price approaches a key level during an active session. It pushes through that level, triggering breakout traders and stop losses. It fails to continue. Rejection appears. Lower time frame structure breaks, and you enter after confirmation, not at the extreme, using the rejection zone as your invalidation. This approach removes guessing from trading and replaces it with evidence, which is why it works consistently over time. Entries should be refined on the 5-minute or 15-minute chart, because these time frames allow precise stop placement and favorable risk, and you are not looking for perfection, you are looking for confirmation, meaning rejection candles, structure shifts, and controlled pullbacks into areas of interest. Indicators are optional, but price behavior is mandatory, because gold speaks clearly if you listen to what it is doing instead of what you want it to do. Risk management is non-negotiable in gold trading, because gold's volatility magnifies both profits and mistakes, which means risking less is the secret weapon, not risking more. And most professional gold traders risk between 0.25% and 0.5% per trade, because consistency comes from survival, not aggression. If you cannot handle losing several trades in a row without changing your behavior, your risk is too high, regardless of how good your strategy is. One of the most powerful habits in gold trading is taking partial profits, because gold often delivers fast reactions followed by sharp pullbacks, and by securing partials at 1-to-1 while allowing a runner to target the next liquidity level, you smooth your equity curve and reduce emotional pressure, which keeps your decision-making clear. This is how professionals extract money from gold without needing to predict massive trends every day. Psychology plays an outsized role in gold trading because losing streaks are mathematically inevitable, and your success depends not on avoiding them, but on responding correctly when they happen. And traders who revenge trade gold, increase size emotionally, or abandon their plan during drawdowns are not failing because gold is hard. They are failing because they are undisciplined. Gold rewards those who remain calm, patient, and consistent, especially during periods of frustration. Another reason gold is the best market to trade is that it provides clear feedback, because when you make mistakes in gold, the consequences are immediate, which accelerates learning and forces growth. And while that can be painful, it is also what turns disciplined traders into professionals faster than slower markets ever could. Gold does not allow laziness, but it rewards preparation. Professional traders understand that gold is not about catching every move, but about choosing the right moments, the right levels, and the right conditions. And by trading fewer setups with higher quality, journaling consistently, tracking emotional responses, and focusing on execution rather than outcomes, gold becomes structured instead of chaotic. The traders who last are not the ones chasing excitement, but the ones mastering boredom and repetition. In the long run, gold stands out because it combines liquidity, volatility, respect for levels, and strong behavioral patterns driven by fear and uncertainty, making it one of the most reliable markets for disciplined traders who understand liquidity and timing. If you master gold, you master patience, risk control, and emotional discipline, and those skills transfer to every other market you trade. If you commit to one strategy, one session, one risk model, and flawless execution, gold will stop feeling unpredictable and start feeling logical. And when that happens, trading transforms from stress into structure, because gold is not the enemy, it is the ultimate teacher, and those who learn its lessons earn the right to profit from it consistently.